Det var jo de årene da en hadde nok så sterke indre brytninger. Indre brytninger.
Hei og velkommen til Noen har snakket sammen. Mitt navn Aksel Fjellavli.
Og jeg heter Tiril Ryston Halvorsen.
I denne episoden her skal vi snakke om handelskrig og ulikhet, og hvordan de to henger sammen. Fordi det gjør de faktisk. Og internasjonalt de siste par årene så har det vært mye snakk om globalisering, eller hvorvidt vi går mot deglobalisering, at det snur. Det har vært mye oppmerksomhet rundt handelskrigen mellom USA og Kina, hvis man skal kalle det det. Det i hvert fall mye bråk mellom Trump spesielt og Xi i Kina.
Ja, så i denne episoden så skal vi da ha besøk av en som heter Matthew Klein, som en av to forfattere av en bok som heter Trade Wars are Class Wars, med undertitelen How Rising Inequality Distorts the Global Economy and Threatens International Peace. Intet mindre. Og han, Matthew Klein, skribent i en publikasjon som heter Barron's i USA, som vel en søsterpublikasjon til Wall Street Journal. Og den boka har fått mye gode omtaler, så vi tenkte at det var interessant å høre nærmere med han. Så resten av denne episoden vil være på engelsk, så bear with us.
Matthew Klein, welcome to the show.
Thank you very much for having me.
Can you just try to explain to us the main thesis on why does domestic inequality and a trade surplus go together?
So the basic argument of the book, the reason we call it Trade Wars are Class Wars, is because we want to challenge the dominant narrative that economic conflicts between countries are driven by national interests or incompatible cultures or things of that nature, and that governments are working on behalf of what's good for all the people who live in their country. And so, there's this zero-sum mentality that what's good for Chinese workers is bad for American workers. And our argument is that that's not the right way to think about this at all, that actually the reason we have these economic conflicts are they're really driven by internal dynamics, that what's bad for Chinese workers is good for Chinese elites, and Chinese elites are doing those things deliberately, often in cooperation with elites in the US and Europe and elsewhere. And as a consequence, or side effect even, that workers in the US and Europe are harmed. And, to your question about why does inequality lead to domestic inequality or domestic imbalances lead to essentially external or international imbalances, is because the world as a whole is essentially a closed system, and that something that happens in one part of the world is going to be transmitted inevitably one way or another to other parts of the world through trade and through finance. You can draw analogies to the environment and pollution if you want. It's the same kind of idea. There's nothing that's perfectly isolated or cut off. So if you have a situation, for example, where in one part of the world, the people who tend to consume everything that they earn, in other words, they spend everything that, you pay someone, and then over the course of their life, they'll basically spend that money on goods and services that create jobs for others. And then you have a shift or a transfer away from those people to people who would prefer instead to buy financial assets. Then what you're going to see is that somewhere else in the world, there's going to be some sort of offsetting response, that there has to be, greater issuance of financial assets, lower consumption of goods and services, and that's going to have all sorts of problematic effects. And so the reason why we see these trade imbalances essentially are consequences of this. And on another way of looking at it is you can sort of zoom out and say globally, forgetting any country borders, if you have the changes that we've observed in the shift of the distribution of income, that has to lead to an increase in indebtedness globally, that it's not possible for businesses to keep selling goods and services and to keep generating profits if the consuming class doesn't have a growth in their own spending power. unless there's a rise in debt to offset that. Could be government debt, could be household debt. And, as long as the debt and net spending and so forth isn't necessarily rising in the same places where the inequality is rising, you have differences across countries, you're going to see trade imbalances as a consequence. And that's the point we're trying to make.
And you make a distinction between two types of developing models, that you have countries that have a high saving developing model and countries that have what you call a high wages model. Can you explain the difference between the two models?
Basically, all economic production is either consumed or it's used as an input for investment. And if you want to grow over time, you need to invest in things that are productive and increase your capacity to produce more things. And there's essentially two ways of doing that. One is, and these aren't mutually exclusive, so a lot of countries use both. But one approach is essentially you sort of squeeze ordinary people, take as much resources from them as you can, and then channel those resources and that labor into investment goods. And so the most extreme example of this is, say, Stalin and the Soviet Union in the 1930s, where you have millions of people starving to death. Farmers are basically having the peasantry is having essentially all of their grain exported elsewhere, so that resources can be imported from Germany and other places. That's then used to develop, an indigenous steel industry and, heavy, electric power, the military apparatus that ends up being, useful to the Soviets later. That's sort of an extreme approach. And then you can think of another way of looking at this, which is instead of relying on sort of internal resources to pay for your development, you can instead create an attractive market and have other people pay for your development. And so you can look at, say, for example, what happened in the United States or Canada or Australia in the 19th century, where essentially you have a high income and rapidly growing consumer market. And that encourages both savers in those countries, but also importantly, people in the rest of the world, like the UK or the Netherlands, for example, to pay to give, essentially lend you resources that you can use to develop, and create those investment goods domestically. So the surplus and development models can go together. I mean, to oversimplify a little bit, the high savings model tends to lead to trade surpluses because, you suppress consumption. You can do that more effectively than you might suppress investment, and then that would lead to a surplus. It doesn't always work that way. You can say South Korea, for example, had trade deficits for a very long time, even though it also had a high savings model, roughly speaking. But in general, the high wages model is all about saying we're going to import, because we don't want to squeeze people domestically too much. We're going to, take advantage of resources in the rest of the world. If you're an aging society with not a lot of domestic growth prospects, it probably makes sense to have some sort of a surplus. And, being essentially, if you, an advanced economy, not donating, but essentially using your excess production to help people who are poor or younger in the rest of the world to develop. Norway itself is actually an interesting example of this, wherein, at the time when the oil and gas was discovered, I guess in the late 1960s, and Norway did not have the resources domestically to develop those. And you had a period of very, very large trade deficits to essentially import the capital goods necessary to develop those resources without, having Norwegian people starve. And then once the oil and gas came online, then that generated a surplus that was essentially, the government, because of the owning a lot of those resources, was able to sort of save and put away for a time when the oil was depleted. And now that sort of puts Norway in a useful position. But that, the nature of having sort of finite commodity resources is an important part of the story, but it's not in general the big driver of these imbalances that we talk about. But it's an interesting and relevant point.
You describe some countries a little bit more in detail in your book, one of them being Germany, which has had a large surplus over time. And I think that most people in Norway would understand this as an outcome of a strong German exports industry, recognizable brands such as Volkswagen, Bosch, Siemens, and so on. And others would maybe point to weak development among Germany's trading partners. But you say that this surplus is rather caused by rising inequality in Germany. What do you understand that they don't?
So I guess the first way to punish back is those brands are not new, but the surplus is new. So if you look at the German economy basically before the year 2000, sometimes there were trade surpluses, but and sometimes there were trade deficits, but usually these weren't that large relative to the size of the German economy. It's basically sort of plus minus 2%, for decades. After 2000, you see this big change where what had been essentially a slight trade deficit throughout the 1990s turns into a very large trade and current account surplus of something like 8% of GDP, and it stayed there pretty consistently. And so you have to ask, did something fundamental change in German corporate culture or German household behavior? And the answer is, well, corporate behavior did change, but it wasn't the culture, it wasn't the quality of the products. German exports are often quite good. I have no issue there. But if you look at the data, German exports grew at a much slower rate during the period when the trade surplus was rising, and really ever since the past 20 years, than in the years before. The reason why the surplus emerged because imports grew even more slowly. And that's not because Germans, suddenly switched from buying things from abroad to buying things made at home. What happened was that just the German economy as a whole just grew much more slowly, and domestic demand was weaker. And so you had basically three things happening at the same time. You had households spending less, and there's no mystery there. It's because they were getting paid less and they were working less. You had the government cutting back on public investment spending, and you had the corporate sector as a whole cutting back on business investment. And so collectively what happened was that there was less spending going on in Germany, while the large sort of 25% of the German economy that was selling to the rest of the world and could essentially ignore German domestic conditions continued to sell their goods, sort of growing at the rate of global GDP. And that essentially led to a big, that coincided with, not say led to, but that coincided with a very large increase in the profitability of German companies and a sharp increase in inequality. So, the cause of one or the other, these were simultaneous events, but if you sort of look at the details of the political history and the decisions of businesses, which we go into those details in the book, it's pretty clear that what happened was that Germany essentially, there were a bunch of key changes that occurred first starting in the 1990s and then particularly the early 2000s that reduced the spending power of ordinary households in Germany and increased either, shifted resources either to the government or to businesses, and that coincided with an increase in the trade surplus. And, that's not a story of increased competitiveness in any means. It's a story of essentially living below their, the German people living below their means by, at the same time, they increased inequality. These things you can trace back at least to the 1990s in terms of deunionization and wage cuts and so forth. But there was just a long pattern of workers getting paid less. There's a big shift you can see in the data, and people shifting from full-time employment to part-time employment, precarious employment, big increase in the poverty rate among Germans with jobs. A lot of the increase in employment in Germany has come from people in sort of the 55 plus age bracket. People who, maybe they lost their job and then they would have maybe gone on unemployment before taking an early state pension. And now they find sort of a low paid part-time job as a cleaner or something. And that's, affects a lot of the employment data. That's why household income growth in Germany had been quite weak in large part. At the same time that corporate profitability and the government budget balances increased.
You imply in your book that Germany has been important for internationally trade imbalances. What happened?
Yes, it's striking actually that, as you said, Germany is not that large relative to the global economy, and yet it has an outsized impact. And it has an outsized impact even excluding its impact on the behavior of the rest of Europe, because its surplus is so large. You look at it in dollar terms, it was basically had a larger trade surplus than China for a very large period of time, which is kind of remarkable given the different. China is 15 times as many people as Germany, I think. So that's a quite striking fact. But then on top of that, you look at what happened after the Euro crisis. So before the Euro crisis, Germany's trade surplus was effectively canceled out by trade deficits that were in places such as Spain and Ireland and Greece and Italy and so forth. And so Europe as a whole, if you were to look at that as the unit, essentially ran sort of balanced trade. And in fact, that's what European officials said you should do before 2000. You should look at Europe as a whole. But then after the Euro crisis, then that no longer was a sustainable model, because that, the large borrowing and spending that occurred in places such as Spain and Ireland and Greece and Portugal was dependent upon German banks in particular, lending lots of money to businesses and to households and to the governments in those countries. And then they stopped doing that quite abruptly. And there was no offsetting increase in spending elsewhere in Europe. And so the net effect was that you suddenly had this big drop in household spending, in public investment and business investment in all of those major crisis countries without any offset elsewhere. And so overall, you had, similar, essentially the German story writ large just goes to Europe, where, the parts of the economy that sold to the rest of the world sort of grew in line with global GDP, which was at that point not growing particularly quickly, but was growing faster than the domestic economy, which was essentially still, I mean, you can look at the data for, say, 2019, so before the coronavirus, and in Spain and Italy and in Greece and so forth, domestic spending was still well below where it was in, say, 2007, 2008. So there was really no recovery there. And essentially, exports sort of chugged along, and then, that affected Europe as a whole in a very significant way.
And could you spell out the kind of class war angle on what you're saying now in Europe after the financial crisis?
Yeah, so what's interesting is that the response by governments in general was to emulate what they believe Germany to have done. And so that led to a couple of distinct policy choices that ended up disproportionately hurting, people sort of the middle and lower end of the spectrum. So there was big increases in value-added taxes to generate government revenue. There were big cuts in public services and public investment. And there were changes in labor regulations, the idea to be more flexible labor markets. And then the net effect of this was that, you can see this in, there's a study by people at the Bruegel think tank, which is essentially that, people in Italy and Spain who are very, very high income, basically their living standard or their income share or whatever didn't really change in a meaningful way. But basically everyone else, and particularly people in the bottom half, ended up much worse. And that's essentially replicating what you saw in Germany, say, sort of 10, 15 years earlier. And that, I guess one way of looking, this simple way is, you have a lot less money going to people who would spend it on goods and services. They're going to spend less on goods and services and have a lower living standard, and that hurts those people. In Europe, in sort of 2008 and onwards, there were a variety of other things that could have been done besides what were done. You could have had, debt write-downs, for example, instead of what happened in, say, Greece, for example, where the idea was that the government would more or less not default on its debt and instead, would get relatively lower interest loans, but then in exchange would have to cut a lot of public spending. There were alternative options that could have been available. People might say they weren't politically available, but they, conceptually existed. And that would have led to, different outcomes. So the fact that people sort of prioritized and the choices that were made, and I think that reflected in part the sort of the intellectual environment they were in, and who was also, giving the advice and who was being listened to. And that, led to those outcomes.
And your thesis is that this was not only bad for poor people in Greece, for German infrastructure and so on, but also because it is causing international conflict.
Yeah, I mean, it's bad for everyone. So sort of going back to what we were saying at the beginning, that the world as a whole is a global system. So if you have people who are spending less somewhere in the world, sooner or later that's going to, affect the incomes of people elsewhere somehow. So, I mean, this is something that, this was an issue in the United States at the time that people were saying, man, those Europeans, it's because they're having this crisis. They're not getting their act together. It's affecting America's recovery. And I'm not saying that, U.S. policy was perfect or anything by any means, but it just reflects that there are these linkages, and you can see it all over the world, how these things affect people in Latin America. I mean, they probably didn't necessarily, think about it quite explicitly or make that point to European leaders, but everyone is worse off. If you have, a lot of ability to produce things and then people aren't consuming to match that, then you have a glut. And then people, they have to lose their jobs, or they get, not have to, but they get laid off. And then everyone's living below their means. And so that's essentially the global problem.
The US has many of the same characteristics as Germany for the last couple of decades. You have rising economic inequality, you have downscaling of welfare, you have underinvestment in infrastructure. But then you have, if you look at the trade balance, the US is the completely opposite. It has a trade deficit. Does this not weaken your point? What is the difference with the US?
It's really interesting. I mean, one of the things that I was struck by when doing the research on Germany in particular is just how similar were the circumstances in those countries, and often at the same time. So Germany, for example, had a tech bubble and bust at the same time as the US, and a very similar reaction by businesses and cutting spending. You had, cuts in welfare around the same time by sort of center-left governments. So it's striking how you have a lot of these similar developments, and yet, as you know, and as we note in the book, very different outcomes. And so the way to reconcile this is that there's sort of this other factor involved, which is that the U.S. Legal system and financial system are such that they sort of offset these other forces because people in the rest of the world, because English is a language that basically any rich person will know, because we're very accommodating to foreign investors. The result is that any excess saving anywhere in the world, or just any saving anywhere in the world, there's naturally going to be a big bias to put it in the United States. You could be, some Russian oligarch buying Miami condo, could be, a central bank somewhere in a developing country purchasing U.S. Treasury bonds as sort of insurance. Regardless, it's going to end up disproportionately in the United States. And what that means is that the U.S. financial system, because it's not that big relative to the rest of the world, is going to adapt to accommodate the needs of people globally, irrespective of what that does to the U.S. And so essentially what happened is that even though the U.S. had a lot of similar circumstances to what happened in Germany, and even though as a consequence of that, people have documented that, rich Americans and the companies they control had similar behaviors to what happened in Germany in terms of the shift in their saving and so forth. This was offset by something else that didn't happen in Germany, which is this massive, massive increase in borrowing by households in sort of the bottom 90% of the income distribution. Big change in their saving and spending behavior. And this wasn't because there was some massive spending binge either. You look at sort of the growth in consumption in the US as a whole, it actually was slightly slower and sort of a longer term average, trend per person. But what happened was that income growth was much weaker, essentially reflecting the fact that, global demand was weaker. And so that ended up disproportionately hurting American manufacturers and so forth. But people maintained their spending, and they were able to do that because both because the currency was relatively overvalued and because their access to finance through borrowing was greatly enhanced through the financial system essentially expanding credit in a way that hadn't happened before. And so you have this offsetting force that basically neutralized whatever you would have expected to have occurred through changes in domestic distribution of income.
Could Europe end up in the same place as the US if the euro strengthens in the future?
Well, it's an interesting question because I don't know if it's the euro strengthening so much as the fact that the European right now, and maybe this will change, but right now, European leaders seem to have committed to a variety of policies, not deliberately to prevent this, but that would effectively prevent this. So there isn't one large liquid market of assets for people to buy in Europe. Governments are actively discouraged from borrowing at all. And even if they do borrow, you have a whole bunch of different countries that are issuing. And generally there's a perception that countries that are borrowing more are going to be less safe. And so you want to hold that stuff less. So even though in theory, the European economy is definitely large enough, it's not as large as the US, but it's comparable in size. And, there's certainly enough fixed income out there. And so in theory, if you had, if everything were mutualized, for example, you take all the European sovereign debt as sort of one instrument that were backed by the ECB in a manner similar to what exists with the U.S. with treasury bonds, then you could have sort of a comparable financial asset. And, all the talk people have about Europe being, the euro being an alternative reserve currency would be possible. But at the moment, that's not the case. So if that were to change, you could definitely see a change in the dynamic there. And maybe you have some shift between, the U.S. and Europe and people outside either economy. Would there be some diversification there? Europeans, a lot of the money coming into the U.S. in the past sort of 5-6 years actually come from Europe, not from Asia necessarily. So maybe some of that would come home, as it were. And that would be useful because, there's a lot of, useful spending needs within Europe that haven't been taken. But at the moment, not yet.
Looking at the headlines in mass market publications about trade wars the last couple of years, those headlines would most likely be about Trump and about China. And China is a large player in this game that we have not talked about so far. And surprising to many, I would guess, is that even though China is a communist country and sort of through ideology is committed to equality in some sense, they have had rising inequality in the country with a huge part of the population not being able to get the same welfare as the rest of the country and so on. But Xi Jinping has stated that China will have domestic consumption as an important part of their growth strategy. And it appears that the regime has understood your point about stimulating consumption and lowering domestic inequality to grow. And Prime Minister Wen Jiabao said 10 to 15 years ago also that China must heavily support domestic consumption to stimulate growth. But still, you have this trade war with Trump. So what is lacking from the Chinese policy?
So what I think is really interesting there, and you highlighted this, is that, the people at the top understand these issues very well, and they have for a very long time. So my co-author, Michael Pettis, lives in Beijing. He's lived there for almost 20 years and has been writing about these things. And they definitely are aware of his analysis and his arguments. And as you said, Wen Jiabao made this point at least as far back as 2007. And yet, you don't see changes that are significant enough to really move the needle here. And so I think that is revealing of the political economy and the sort of the realities here, which is that even though China is an authoritarian system, and even though Xi Jinping in particular has managed to concentrate power in himself in a way that hasn't really been done in decades, there are nevertheless some really significant limitations on what it is they either can do or are willing to do. And so one thing that we point out is that the kind of model that China embraced starting in the early 1990s, which has been done elsewhere, it has sort of a side effect of when your goal is essentially you're taking resources from the mass of ordinary people to, encourage development by either channeling it to businesses or to governments to invest, you end up creating a very powerful class of people who benefit a lot from that system. So it could be the state banks that like the fact that they have access to sort of guaranteed profit streams and cheap funding. It could be the politically connected businesses that are able to borrow cheaply to make these investments and then profit, and so they can invest more, whether they're explicitly state-owned enterprises or not, doesn't really matter. But as long as they have that access, the real estate developers that can get cheap land because the governments will essentially sort of expropriate the peasants for their land. There are various provincial elites who, one of the interesting features of the Chinese governmental system is that officials are not paid well at all, but they're sort of expected to be able to make money on the side. And then, there's some interesting theoretical papers about how this creates good incentives to promote growth. But, at the same time, it also creates a very strong bias for this particular kind of growth. And, they obviously aren't going to want to change things. And China is also, it's actually kind of a decentralized system. So you do have a lot of power in Xi Jinping. The standing committee in Beijing has a lot of authority, but at the same time, the provinces are quite large. There's a lot of not entirely autonomy, but unless there's a very explicit directive to do something specific, they have a lot of leeway. And the people who are, officials in those provinces, which are basically the size of large European countries, have a lot of autonomy to pursue things. So unless they're really being pushed or they can get targeted in some sort of anti-corruption campaign, they have a lot of flexibility to do things and then push back on things. So if it's not the number one priority of the government, which I guess it hasn't been, then it's very hard to actually put these changes through into practice. And that's why you've seen, despite a lot of changes, and despite even some useful reforms to the Chinese financial system in the past 10 years, the share of the Chinese economy that's actually going to Chinese workers has remained very, very low. It's gone up a little bit since the bottom in sort of 2010, 2011, but it's still very, very low. And, until that changes, you're not going to see sort of real meaningful improvement in the trade, relations that China has with the rest of the world, I don't think.
So it's not really the lack of investment, domestic investment in China. It's more a question of bad investments.
Consumption in China is so low. And that's why they've had these persistent surpluses. I mean, it's basically, so, put a number on it. The share of Chinese output that is consumed by households is less than 40%. It's been less than 40% for quite a long time, which is basically the level you would get either in sort of a very, very, small sort of petro state that when the oil price is high, so sort of a temporary phenomenon, you might see it in a corporate tax haven where the numbers again are sort of inflated, or you see it in places such as, the Soviet Union under Stalin, where again, like you have just an extreme suppression of household consumption. And so, that's really the thing. So China just has this real, weird imbalance there. And so in theory, if all this investment were really productive, then maybe that would be worthwhile. And you'd have rapid growth. And that's what you saw, quite frankly, in the 90s anyway. But if that were the case, you also wouldn't expect, debt to be rising so quickly relative to income, because that means that essentially that the investments aren't boosting your sort of future productive capacity in the way that you would have expected. And what we've seen, in fact, basically since sort of 2008, is that China's debt to income ratio, all forms of debt, increased by well over 100 percentage points of GDP, which is more or less unprecedented, especially when the economy is growing, to have that happen that much and in that short time frame. And so that suggests that it wasn't really constructive. And the fact that they've been clamping down on borrowing until this year, really, or last year, until basically the trade war started slowing things. They really were clamping down on borrowing, clamping down on investment growth. It seems like they recognize that, leadership there recognized that as well.
You highlight a lot of things that China should do in this context, but now we have a new president in the United States. What should Joe Biden do from the American side, or could he do anything to create a less sour relationship with China on trade, or does this have to be solved by the Chinese?
Yeah, it's a tricky question. I mean, part of the reason we wrote the book the way we did is to emphasize, if this is a global problem, which we think it is, and it's a global system, then you really have to have the solutions originating and being implemented in the places that are sort of the sources of this distortion. So, the U.S. can do things and the U.S. can make exhortations, but A, the U.S. is not perfect in this regard, and B, there's only so much that can be done from the U.S. side of things. I mean, sort of going back to the beginning of the book, part of the problem historically has been that it's not as if the U.S. government has been taking positions that are for the U.S. as a whole. It's for particular segments of the U.S. And whether that's because people didn't know any better, because of who had more political influence or what. I mean, there's probably multiple forces at work, but it's not as if this is the U.S. versus China. The Chinese government should want to make these changes insofar as it's good for the vast majority of people who live in China. Just as the things we talk about in Europe are things that Europeans should want to do for their own sake. The fact that they also would have side benefits for people in the rest of the world is sort of a nice plus. But that's if they don't want to do that for their own reasons, then I don't see how there's anything directly the U.S. could do to persuade them that isn't sort of either just telling them things they already know or sort of punitive measures that might backfire.
So the solutions have to come from, say, China, from the Eurozone, and not from other countries, say, blocking the surpluses from investing in their economy.
Well, that could work. I mean, that's where I sort of get to the punitive angle, which I think that, there's sort of the constructive and destructive approaches here. So the ideal answer is that you see changes in places, including in the U.S., although the changes would look slightly different. And then that would make everyone better off and we could all be happy and, say, oh, that was an interesting little period of history. But, alternatively, you could have societies that seem to be on sort of the, in the extent that the U.S. and the other English-speaking economies tend to be necessary counterparts to the surpluses elsewhere, that the shifts in the distribution of income wouldn't be sustainable in or much harder to sustain in Europe and China and elsewhere without sort of the offsetting changes in the financial system in the US and UK and Canada and so forth. If the English-speaking economy essentially decided to block that money coming in, or at least make it less attractive to come in, you can imagine how that might change sort of the dynamics, and it would make it harder for the balance that exists within Europe and within China and the major surplus economies to be sustained, and they might create pressure for them to change their distribution of income internally, or at the very least, it would sort of shift the negative side effects to third countries that didn't do that. But that's not. I mean, that could work, and I'm not saying that it should be rejected, but it's not the sort of the obvious constructive solution. And so I think we'd have to, maybe that's what you have to do, but I think it's something to be aware of what the potential costs and dangers are of doing it.
Are these thoughts of like the Green New Deal and these huge investment packages that's been talked about in the US and also in Norway and other European countries a more constructive way to boost domestic demand and consumption in our countries?
I mean, I think that those kinds of things can be helpful. I mean, there are probably a lot of different things that could be done in different places. So I don't, I'm not going to talk about every country specifically, but I think that's certainly reasonable. I mean, especially if you think that, changing the energy, generation and consumption systems is a good thing anyway, then it seems like, it's sort of a 2-for-1. You definitely want to be doing that sort of thing. And that would definitely help. I mean, I think, I don't know if that's sufficient. But again, like every country is sort of different in terms of the mix between what's going on with, household spending versus, overall public investment. I mean, some cases, Europe is very easy because really everything is lower than it should be. So, you could do that and other things and it would be straightforward. You look at, say, China, and maybe there should be a shift in how investment is done in terms of what they're focusing on. The fact they're still constructing, coal power plants and so forth makes you sort of wonder about the commitment to the, carbon neutrality. But, at the same time, it's also a situation where you have so many Chinese people are so vastly underpaid compared to what they produce. And the social safety net in China is so bare compared to what you see in a lot of other societies that, fixing that is also something that should be really prioritized. So you could probably do both. But, the specific mix would depend on each country.
I have one final question. As a non-economist, I had to look up John Hobson, which you quoted in the start of your book. And Wikipedia said he was most famous for inspiring Lenin and his theory of imperialism. And the title of your book, Trade Wars Are Class Wars, may also be read by some as a nod in the direction of Leninist theory. So what do you feel of such a reading? And do you see trade surpluses as being pushed onto other countries as a form of imperialism?
So first of all, we're not Leninists, and I think it's actually interesting to look at the difference between what Hobson wrote and what Lenin wrote. And I definitely agree with you that the reason Hobson is still known today is generally because Lenin cited him. But I think it's interesting to, the difference in the argument is that, Lenin viewed what Hobson diagnosed as sort of an inevitable feature of capitalism, and that imperialist conflict was how capitalism would end. And Hobson's point was different than that. It was that, there were certain problems in the distribution of income in Western Europe, and that those problems were both ameliorated by and also encouraged imperialism by those countries in a way to find new markets. So there's an important distinction there. I mean, his point was that this was a fixable problem without, Bolshevik revolution. And so, that would be, where we are on that point. I think that, to the Hobsonian, to get too much into it, but basically it's that the domestic inequality creates this weird impact on the rest of the world. That the fact that, in England in the late 19th, early 20th century, you had this distribution of income being the way it was, or workers were vastly underpaid and the industrialists got all these profits they didn't really want to invest at home or spend, led to big flows of capital out of the country. And that encouraged, among other things, the scramble for Africa and India and China and so forth. Also went to places like the US and Australia and so forth. So it wasn't all that. But, I think that is relevant for understanding the world we live in now. That, there's a paper by an economist at the US Treasury Department about 10 years ago that made this point explicitly. We cite him. His name is Kenneth Austin. He made the point that actually China is basically sort of the, peak imperialist, economy of the world today from that sort of perspective, or 10 years ago, I guess, from that perspective, in the sense that because the distribution of income in China is so skewed, the only way to make it work, where you have, rising sales, to generate incomes to pay people and keep them employed, but also, not having those people buy the things you're producing, you have to have some kind of alternative places in the rest of the world where you're selling to them. And then they're financially not dependent on you in the sense that Americans literally couldn't spend the money themselves, but at least the financial arrangements as it is that, Americans borrow a lot, Chinese lend a lot. So you can see that linkage there. And so, yeah, I mean, it makes sense. Obviously, it's not a situation where the U.S. is a subject state of anyone. But from an economic perspective, you can definitely draw an analogy to the world then and see how those dynamics play out now in the modern world. The big difference, of course, is that now it's much more consensual and takes place with democratic governments generally being okay with these things. And that's sort of interesting and novel development. I don't know how sustainable that is. Seems like the answer is not entirely. So that's a difference. But I think that's sort of how you can. I mean, we explain this more in the book, obviously, but that you can see the linkage and I think the value of Hobson's analysis in the modern world.
Det var en spennende, interessant samtale. Man burde lese den boka hvis man ble nysgjerrig nå. Så den kan vi anbefale i hvert fall først, men vi har kanskje et par andre også.
Det har vi. Jeg tenkte å anbefale å følge med på. Det er jo et program som går på P2 som heter Debatt i P2, og der er det ofte mye bra. Men nå i desember så er det også 3 debatter eller møter da, i regi av tankesmien Agenda som sendes der. Et som heter Ensomhetens politikk i koronaens tid. Et som heter Gjør korona oss mer ulike. Og et som heter Er vi klare for neste krise? Så det blir sendt da i løpet av desember på den flata der som heter Debatt i P2. Så der går det jo an å følge med både generelt, men også spesielt nå, for å få med seg disse arrangementene.
Ja, det er sikkert mange som sitter hjemme og ser på The Crown for tiden, og der møter man Margaret Thatcher. Det er faktisk 30 år siden hun gikk av i år. Studio 2 på P2 hadde denne uka et 15 minutters innslag hvor de ser nærmere på arven etter Margaret Thatcher, og da møter du blant annet Nick Sitter fra BI, som har vært gjest i podcasten her før, og Christian Steines fra NTNU. Så den heter Arven etter Thatcher på Studio 2-podcasten. Så den anbefaler jeg for å...
Så dobbelt NRK P2 der da?
Ja. Sånn må det være. Yes. Da snakkes vi igjen neste uke.
Det gjør vi.
Ha det bra.
Vet du hva som skjer når du må jobbe mer enn du sover?
Nå sliter jeg. Jeg klarer snart ikke å holde øya oppe.
Eller hvordan det føles å ikke ha noe å gå til?
Jeg skulle veldig gjerne ønske jeg kunne jobbe i stedet.
I Røsla så får du historier fra grasrota i arbeidslivet.
Altså det er vel en del folk som kanskje føler at det er mindre verdt å være renholder.
Du finner Røsla der du hører på podcaster.